Hello, world. It's John Pinto, your roving realtor, bon vivant, video blogger, podcaster, and home chef. And I am here with Abel Fregoso from Homebridge Mortgage in SoCal. How are you today, Abel?
I'm doing great, John. Thank you for having me. Really appreciate it.
You're looking very handsome in your branded attire.
You can see my background is from the
Uh,
steps for home
oh,
ownership
yeah.
with
hmm
CAR, California Association of Realtors, which, by the way, we have another one scheduled for April 7th.
Oh, I'll have to make sure I tune in on that. And
Yeah,
I am
we have a
very
lot of good
thankful.
stuff.
I'm very thankful that your shirt is red and your hat is white, as opposed to having a white shirt and a red cap, because
Right.
people might misjudge you then, you know? I can't even wear any of my red caps anymore. You know what I mean? I can't wear
Yep,
them. My
absolutely.
Bishop Ford high school hat
Oh,
is red. I can't wear it anymore.
that's
So
funny.
anyway, that's as controversial as I'm going to get on this podcast. I know you mentioned that Mark Farfel, our hero from Finance Rescue at CAR. Is that
Yes,
correct?
that is
He,
correct.
that he's our hero, and he's
Yes,
from Finance Rescue from CAR.
yes, he
And
is.
he
He's there.
likes talking about niche products.
Yes, he does.
Let's run down that laundry list of niche products. Which one do you find is the most in demand?
So let me just give you a brief background on how
Yeah.
this all came about. During the Dodd-Frank era, where they put together all these lending guidelines, they came up with a term called qualifying mortgage, QM. And all the QM loans are those that are designated as your standard products, where there's no balloon payments, there's no prepayment penalties. You have to fully qualify tax returns, pay stubs, bank statements, the whole thing. I mean, it's a box about this big that you have to put your client in. And so they said, okay, these QM products are for your people that can verify their income and that can show enough assets and whatever to qualify. Then all of a sudden, the whole concept of non QM, non qualifying mortgage, came to the table, where we now have what are called niche products for individuals that can't qualify in this box. So let's take a few. Some of our audience that are realtors are 1099. Well, they have money going through their bank account, but they don't show it on their taxes because they don't want to pay Uncle Sam. So we design what is called a bank statement loan, and it could be 12 months personal bank statements or 24 months business statements. And what we do is we take the deposits. There's no transfers that are allowed, only deposits. And then we average them for either the 12 months or the 24 months. And
No
that
tax
gives us
returns. No tax returns.
no tax returns, no pay stubs, nothing like that.
Okay, help me here. What is the delta on the loans in the box for the husband and wife with the income and the credit and the verification of deposit, and the ones out of the box?
It's going to be about 2%. And
Okay.
I have a perfect example. I've got one that I just quoted the borrower of 4.75, and we were doing it in a investor cash flow program. He fell off his chair and said, "Wait a minute, that's way too high. I've been seeing on TV 1.99, 2%. Why are you giving me 4.75?" Well, because you're not in this box with
Yeah.
tax returns and pay stubs and all that. You're outside the box. You're a non QM borrower, so you're going to pay that premium. But it's
Okay.
not that bad.
Yeah. So let's drill down on what is really required. Obviously, you're going to want to verify their seasoned cash, correct?
That is correct.
So
60
that
days.
doesn't change. That doesn't
That
change.
does not change. Correct. Correct.
I'm going to imagine that the credit scores are going to be about the same as far as what's required. Is that correct?
Yeah, and really where it's gonna be different is gonna be based on the loan to value.
Okay. So when you're going in the box, you're going 97% loan to value, 95, 90, 80. What kind of loan to value are we talking about on these non QM loans?
We're talking 90%. There's got to be a 10%
Oh,
skin in the game.
that ain't bad.
Or yeah, You're going to have a higher credit score, and you might have a little bit more of a bump on the rate as the LTV goes up and as the FICO score goes down. So that's the beauty of these niche products, is that they can be adjusted based on LTV and FICO score.
Okay. Now, as the loan to value ratio goes down, so to speak, you're at 50% loan to value rather than 80%. Does that have any effect on the interest rate?
Yes, it does. Yes, it does, because there's less risk. One of the things that people don't understand is that today's pricing is based on risk-based pricing. So the higher the risk, the higher the interest rate. The lower the risk, the lower the interest rate. So that's what we're going to be seeing in moving forward.
Let's quantify this. So, on one of these non-qualifier mortgages that's 80% loan to value versus one that's 50% loan to value, what might the delta be in the interest rate on those two examples?
About a half a percent. Half a
That's
percent is what you're
significant.
gonna, you know,
Okay.
instead of
So
that
maybe
four
we're
and three,
talking, go ahead.
instead of that 4 3/4, you're looking at 5 1/4.
Okay. I got you. That makes perfectly good sense. Yeah. So, I mean, when you're presenting it to the client, you give them either or. You either give me all of this stuff and you're in the box with the 2.5% rate,
Correct?
or you don't give me this stuff and you get the loan that you need anyway, but you're paying 4.5% or whatever
Absolutely.
the rate is.
Right.
Okay.
Right.
So I'm thinking doctors, attorneys, dentists, realtors, mortgage brokers, car wash owners, anybody who's an entrepreneur or in sales with wildly fluctuating income is probably good for this program, correct?
Absolutely, because you can have a very good first quarter of deposits. The second quarter is not so good. Third quarter is great. Fourth quarter slows down. We're going to average all 12 months, and that's going to be where the income is going to be set at.
In general, if you're going to quote unquote seasonal the income, dollar cost average the income, what's your sweet spot? Are you going back 36 months?
No, it's either the 12 months for personal or the 24 months for businesses. Those are the qualifying months for the averaging.
Oh, is that so?
Yes.
Oh, okay.
Yes. Yeah.
Okay.
Again, a lot of, for instance, realtors will have a business account under their business name, and that's where we would need 24-month bank statements, and then we average the deposits over the 24-month period.
Okay. I think I understand. Very good. So, are there any other niche products, or is this the niche category of products?
This is the bank statement loan is the best product for those entrepreneurs, as you call them, where they're
Yeah.
able to reduce their taxes significantly to reduce their liability in taxes. So they can't show much income, but they have the cash flow going through. We have another product which is called the investor cash flow, which is designed for investors, property owners, landlords, where as long as the mortgage payment and the rents are equal, then you don't verify any taxes, any income, nothing like that. So,
Okay. Gotcha. So let's conclude on this, because this is a breath of fresh air for entrepreneurs whose eyes cross when they go in to see a regular in the box lender
mhm,
and it just doesn't work, even though
correct.
they're making all kinds of income. So they have to give you their verification of deposit, stock certificates, and bank accounts, and all that stuff. Correct?
That's
Credit
correct.
credit report,
Credit report, yeah, and there's going to be
and
a
then
minimum
and
score.
then 12 to 24 bank statements. The most recent 12 to 24 bank statements.
If the bank statement is in the name of a business, 24 months. If it's personal, then it's only 12 months. Okay. But
Hmm.
one caveat that I did not mention is that if you're going to use the 24-month bank statements, which shows a business, we have to assume a 35% expense ratio. So if the deposits are roughly an average of $15,000, then we give it a 35% haircut because that assumes the expenses that that business is incurring.
Okay. Yeah, I could see where you would do that. I could see where that could be problematic for someone who is working out of the house and doesn't do any advertising. But I could see the haircut coming. I
Yeah.
could see the haircut coming. Yes,
Hmm.
indeedy.
Hmm.
Okay, so what words to the wise would you have to our viewers on this?
The bottom line is that you have to expand your knowledge that there are more products in the market that can fit your needs. Even though you don't have tax returns, even though you can't verify how much you make, there are products out there that will allow you to get into a home, buy a property. But the bottom line is they have to understand that there is a premium associated with that out of the box type product.
Makes perfectly good sense. And is that product good for 1 to 4 units, or is it just owner occupied?
It's 1 to 4 units, absolutely.
Owner occupied or not owner occupied? Either way.
Either way, correct. It's just going to depend on the loan to value.
Okay, very good, very good. Um, so thank you very much for imparting all of this information. This is very helpful, especially to entrepreneurs. And thank you all for tuning in, and we will see you on the next video. Bye for now.